If you've ever felt lost, confused, or downright terrified by the stock market, you're in the right place. Today, we're diving deep into a book that legendary investor Warren Buffett calls by far the best book on investing ever written. We're talking about The Intelligent Investor by Benjamin Graham. Graham wasn't just an investor, he was Warren Buffett's mentor, the father of value investing, and a man whose wisdom has guided generations of successful investors through booms, busts, and everything in between. This book isn't about getting rich quick. It's not about secret formulas or crystal ball predictions. It's about building a framework for making rational decisions, protecting yourself from devastating losses, and cultivating the mindset needed for long-term financial success. In this video, we'll unpack the core principles of The Intelligent Investor. We'll explore the crucial difference between investing and speculating, meet the fascinating character of Mr. Market, understand the single most important concept in investing, the margin of safety, and learn how to manage the biggest risk of all by yourself. Get ready to transform the way you think about money and the markets. Secret 1: Are you an investor or a speculator? It matters. Graham starts with a fundamental distinction, one that Wall Street often blurs, much to the detriment of ordinary people. Are you an investor or are you a speculator? It sounds simple, but getting this wrong is the root cause of most financial disasters. Graham defines it clearly: an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Let's break that down. Investing requires three key things. 1. Thorough analysis. You must rigorously study a company's business, its financial health, its management, and its intrinsic value before you buy its stock. This isn't about guessing, it's about evaluating. 2. Safety of principal. Your primary goal isn't necessarily hitting home runs, it's avoiding catastrophic strikeouts. You must deliberately protect yourself against the risk of serious loss. 3. Adequate return. Forget chasing astronomical gains. An investor seeks a satisfactory, reasonable return, not necessarily the highest possible one. A speculator, on the other hand, is primarily focused on predicting price movements. They buy because they think a stock will go up, often without a deep understanding of the underlying business. They might rely on charts, tips, hunches, or the simple and dangerous belief that it's going up, so it must keep going up. Graham warns that most people who think they are investing are actually speculating. They trade frequently, chase hot stocks, buy based on headlines, and panic sell when prices drop. This isn't investing, it's gambling with worse odds because the house, Wall Street, takes a cut every time you play. The intelligent investor treats buying a stock like buying a piece of a business. They ask, what is this business worth? The speculator asks, what will other people pay for this stock tomorrow? Big difference. Secret 2: Meet your manic depressive partner, Mr. Market. Now, let's meet one of Graham's most brilliant creations, Mr. Market. Imagine you own a share in a private business, and you have a partner named Mr. Market. Every single day, Mr. Market knocks on your door and tells you what he thinks your share is worth. Not only that, he offers to either buy your share from you or sell you his share at that price. The catch? Mr. Market is, well, he's bipolar. Some days, he shows up euphoric, seeing nothing but a rosy future. On those days, he quotes a ridiculously high price for your share. Other days, he's inconsolably depressed, convinced everything is doomed. On those days, he offers to sell you his share for pennies on the dollar, or buy yours at a desperately low price. Mr. Market has one other lovely trait: he doesn't mind being ignored. If his quote today seems silly, you can just tell him to go away and come back tomorrow. He's there to serve you, not to guide you. This allegory is Graham's genius way of explaining the stock market's often irrational fluctuations. The prices flickering across the screen are Mr. Market's daily quotes. They reflect his mood swings, his temporary enthusiasms and fears, not necessarily the true underlying value of the businesses. The intelligent investor understands this. They don't let Mr. Market's mood dictate their own. They don't feel richer just because Mr. Market is euphoric, nor poorer just because he's depressed. Instead, the intelligent investor uses Mr. Market. When Mr. Market offers shares at a ridiculously low price in a fit of pessimism, the investor happily buys. When Mr. Market, in his mania, offers a ludicrously high price, the investor might consider selling. The rest of the time? The investor ignores Mr. Market and focuses on the actual performance of the businesses they own. You don't have to trade just because Mr. Market shows up. His quotes are an opportunity to buy low or sell high, but never an obligation. Don't let his mood swings become your own. Secret 3, the secret weapon, margin of safety. If there's one concept that forms the bedrock of Graham's entire philosophy, it's the margin of safety. He calls it the central concept of investment. What does it mean? Simply put, the margin of safety means never overpaying for an investment. It's about buying a security for significantly less than its underlying value. Think of it like building a bridge. If you expect the heaviest truck that will ever cross it to weigh 10,000 pounds, you don't build the bridge to hold exactly 10,000 pounds. You build it to hold 20,000 or 30,000 pounds. That extra capacity is your margin of safety, protecting you against unforeseen stress or miscalculation. Investing works the same way. You analyze a company and estimate its intrinsic value, what a knowledgeable buyer would pay for the whole business. Let's say you calculate that value to be $50 per share. The margin of safety principle dictates that you shouldn't buy the stock at $49, or even $45. You should wait until the price is significantly lower, perhaps $35 or $30. That difference between the estimated value, $50, and the price you pay, $30, is your margin of safety. Why is this so crucial? Because the future is uncertain. Your analysis might be flawed. The company might face unexpected problems. The economy might take a downturn. The margin of safety provides a cushion against these unknowns. It doesn't guarantee you won't lose money, but it significantly improves your odds of avoiding a major loss and increases your potential for profit if things go well. If you buy a stock valued at $50 for $30, even if your valuation is a bit optimistic and it's really only worth $40, you still bought it below its value. Even if the company hits a rough patch and its value temporarily drops to $35, you're still protected from a major loss. The lower the price you pay relative to the underlying value, the larger your margin of safety. This concept applies not just to individual stocks but to the overall market. When the market is high and stocks are expensive, meaning their prices are far above their underlying values, the margin of safety is thin or non-existent. When the market is low and stocks are cheap, the margin of safety is wide. Graham stresses that the margin of safety is what truly distinguishes investment from speculation. An investment provides a demonstrable margin of safety based on analysis of the facts. Speculation relies on hoping the price will go up, regardless of underlying value. Secret 4, taming the beast, your own worst enemy. Graham makes a profound observation: the investor's chief problem, and even his worst enemy, is likely to be himself. Success in investing doesn't come from having a stratospheric IQ or inside information. It comes from controlling your emotions and behavior. We just talked about Mr. Market and his wild mood swings. The danger isn't Mr. Market himself, but our reaction to him. Humans are hardwired to follow the herd. When everyone else is buying frantically and prices are soaring, we feel an almost irresistible urge to jump in, fearing we'll miss out. When everyone is selling in panic and prices are plummeting, fear grips us, and we feel compelled to sell before things get even worse. This is precisely the opposite of what you should do. The intelligent investor, Graham insists, profits from pessimism and resists optimism. You should be greedy when others are fearful, and fearful when others are greedy. Sounds easy, right? But it goes against our deepest instincts. That's why discipline and emotional control are paramount. Graham highlights several psychological traps. 1. Following the crowd, assuming that because many people are doing something, it must be right. In investing, the crowd is often wrong, especially at extremes. 2. Over-optimism in bull markets, believing that good times will last forever and paying ridiculously high prices. 3. Excessive pessimism in bear markets, concluding that stocks will never recover and selling out at the bottom. 4. Impatience, expecting results too quickly and abandoning a sound strategy just because it hasn't paid off immediately. 5. Anchoring to recent events, letting short-term market noise distract you from your long-term plan. How do you combat this? 1. Know yourself, understand your own emotional triggers. Are you prone to euphoria or panic? 2. Have a plan, define your investment goals and strategy before you start. Write it down. Stick to it. Automate decisions where possible, like regular monthly investments. 3. Focus on value, not price. Remember Mr. Market. Price is what you pay, value is what you get. Don't let daily price fluctuations dictate your view of a company's worth. 4. Think long-term. Investing is a marathon, not a sprint. Don't check your portfolio constantly. Focus on the decades ahead, not the day's headlines. Mastering your own psychology is the hardest part of investing, but it's also the most critical for achieving long-term success. Secret 5. 2 paths to success: defensive versus enterprising. Graham understood that not everyone has the time, skill, or inclination to devote countless hours to analyzing stocks. So, he divided investors into 2 types, the defensive and the enterprising. Both can be intelligent investors, but they take different paths. The defensive investor: this investor's primary goals are safety of principle and freedom from bother. They want decent results with minimal effort and decision making. They are not looking to beat the market, just to participate sensibly in its long-term growth while avoiding major mistakes. Graham's prescription for the defensive investor is simple. 1. Diversification. Own a broad range of stocks, perhaps 10 to 30 well-established companies, or simply buy shares in low-cost mutual funds or index funds that own hundreds or thousands of stocks. This avoids the risk of being wiped out by the failure of a single company. 2. Quality. Stick to large, prominent, conservatively financed companies with long records of continuous dividend payments. Avoid speculative or unproven businesses. 3. Price discipline. Don't overpay. Graham suggested specific limits, like not paying more than 15 to 20 times average earnings or 1.5 times book value, though these need context today. The key is avoiding obviously high prices. 4. Simple portfolio. Maintain a relatively fixed allocation between high-grade bonds and diversified stocks, perhaps starting at 50-50 and adjusting periodically if the balance shifts significantly due to market movements. The enterprising investor. This investor is willing and able to devote significant time and effort to researching securities and managing their portfolio. They aim for better than average results, not through speculation, but through more intensive analysis and selection. Graham suggests several avenues for the enterprising investor, often focusing on areas neglected by the crowd. 1. Buying unpopular large companies, identifying large, solid companies that are temporarily out of favor and selling at low prices relative to their earnings or assets. 2. Bargain issues, searching for stocks selling significantly below their intrinsic value, particularly those trading for less than their net working capital, the famous net nets. 3. Special situations, engaging in more complex operations like arbitrages or liquidations where profits depend on corporate events rather than market fluctuations. This is highly specialized. Crucially, Graham warns against a middle ground. Don't try to be half enterprising if you lack the time or skill. Trying to get slightly better than average results without putting in the necessary work often leads to worse than average results. Choose one path, defensive or enterprising, that suits your temperament and resources, and stick to it. Secret 6. Building your bulletproof portfolio. Whether you're defensive or enterprising, your portfolio needs structure. Graham emphasized a balanced approach. Stocks versus bonds. The cornerstone is the allocation between stocks, equities, and bonds, debt. Graham famously recommended never having less than 25% or more than 75% in stocks, with the remainder in bonds. A 50-50 split is a good starting point for many. Why bonds? They provide stability and income, acting as a shock absorber when stocks inevitably fall. They give you the psychological and financial cushion needed to ride out bear markets without panicking. When should you adjust the balance? Graham suggested potentially increasing stock exposure when the market is clearly cheap, offering a wide margin of safety, and reducing it when the market seems dangerously high. However, he cautioned strongly against trying to precisely time the market. A simpler approach is periodic rebalancing. If stocks soar and grow to, say, 60% of your portfolio, sell some and buy bonds to get back to your target, like 50-50. If stocks crash, do the opposite. This forces you to sell high and buy low, systematically. Diversification. Don't put all your eggs in one basket. Owning a variety of stocks across different industries protects you if one sector or company hits hard times. As mentioned, 10 to 30 individual stocks was Graham's guideline, but today, low-cost index funds make broad diversification incredibly easy for defensive investors. Even enterprising investors should diversify adequately. Quality. Focus on financially sound companies. Graham suggested tests like current assets being at least twice current liabilities, and manageable levels of long-term debt. Look for companies with consistent profitability and a long history of paying dividends, signs of stability and shareholder friendliness. Price. This brings us back to the margin of safety. The defensive investor should avoid paying high prices relative to earnings and assets. The enterprising investor actively seeks low prices relative to intrinsic value. Never buy just because a stock seems popular or is going up. Always ask, am I getting value for my money? Building a portfolio isn't about complexity, it's about discipline and adhering to sound principles consistently over time. Secret 7. Danger zones. What not to do. Just as important as knowing what to do is knowing what not to do. Graham provides clear warnings about common traps that ensnare investors. Don't try to time the market. Countless people think they can predict whether the market will go up or down. Graham is blunt, this is speculation, not investment, and it's a loser's game for the vast majority. Market movements are largely unpredictable in the short term. Trying to jump in and out usually results in buying high and selling low, while racking up trading costs and taxes. Beware of growth stocks at high prices. Everyone wants stocks that will grow rapidly. But companies expected to grow fast often sell at extremely high prices relative to their current earnings and assets. Graham warns that you are paying a huge premium for an uncertain future. If that growth fails to materialize exactly as expected, the stock price can collapse disastrously. Paying too much for even a great company can lead to terrible results. Buy growth stocks only when you can get them at a sensible price that provides a margin of safety. Shun IPOs, initial public offerings. New stock offerings are almost always sold during bull markets when optimism is high and prices are inflated. They come wrapped in hype and heavy salesmanship. While some IPOs soar initially, studies show that, on average, they significantly underperform the market over the subsequent few years. The intelligent investor generally avoids them. Ignore short-term earnings. Don't get overly excited by one great quarter or panic over one bad one. Focus on the long-term trend of earnings power, averaged over several years. Companies can manipulate short-term earnings in various ways. Look for sustainable profitability, not temporary blips. Don't follow fashion. Wall Street goes through fads, tech stocks, biotech, internet companies, franchising, conglomerates. Whatever is hot today is often tomorrow's disaster. Buying what's popular often means buying what's overpriced. The intelligent investor looks for value where others aren't looking. Avoiding these common mistakes requires resisting powerful psychological temptations. It means having the discipline to stick to your principles, even when everyone else seems to be getting rich doing something foolish. Secret 8. The investor is owner. Graham reminds us that owning stock means owning a piece of a business. You are a part owner, and management works for you. While Graham became somewhat disillusioned with the ability of small shareholders to influence large corporations, he still believed investors should pay attention to how their companies are run. Judge management. Are they efficient operators? Do they allocate capital wisely? Compare their results against competitors. Are they candid about mistakes, or do they constantly blame external factors? Dividend policy. Graham argued that companies should generally pay out a reasonable portion of their earnings as dividends, say, 2/3, unless they could clearly demonstrate that reinvesting those earnings would generate higher returns for shareholders. He was skeptical of companies that retained earnings merely to expand for expansion's sake, especially if their past profitability was mediocre. Today, the debate continues, with many growth companies paying little or no dividend. The intelligent investor should question whether retained earnings are truly being used productively. If not, that cash belongs in the shareholders' pockets. Stock splits and stock dividends. Graham clarifies that stock splits merely cut the pie into smaller pieces, they don't give you more pie. A 2-for-1 split doubles your shares but halves the price, leaving the total value unchanged. Don't get excited about them. True stock dividends, representing reinvested earnings, are different, but less common today. The key takeaway is to adopt the mindset of a business owner. Think about the long-term health and profitability of the enterprise, not just the daily fluctuations of its stock price. Summary: the intelligent investor's edge. So, what does it truly mean to be an intelligent investor, according to Benjamin Graham? It means distinguishing rigorously between investment and speculation, always grounding your decisions in thorough analysis, safety of principle, and the pursuit of adequate, not extraordinary, returns. It means understanding and harnessing the power of Mr. Market, using his manic depressive mood swings to your advantage by buying low and selling high, but never letting his irrationality infect your own judgment. It means anchoring every investment decision in the bedrock principle of margin of safety, always insisting on buying securities for significantly less than their underlying value to protect yourself against unforeseen troubles and errors in judgment. It means recognizing that your biggest challenge comes from within, controlling your emotions, resisting the pull of the crowd, cultivating patience and discipline, and refusing to let fear or greed dictate your actions. It means choosing the path, defensive or enterprising, that best suits your temperament, time, and talent, and sticking to it consistently. It means building a portfolio based on diversification, quality, and reasonable prices, and avoiding the dangerous allure of market timing, overpriced growth stocks, and speculative fads. The Intelligent Investor isn't just a book, it's a philosophy, a mindset, a lifelong guide. Its principles are timeless because they are rooted in the unchanging realities of business value and human psychology. Following Graham won't guarantee you'll get rich overnight. But it offers something far more valuable: the near certainty that you won't end up poor, and the high probability that you will achieve your long-term financial goals with prudence, confidence, and peace of mind. Thank you for watching. Don't forget to leave a like and a comment. See you next time.